Record. So you want to do the intro, your intro first?
Sure. Drinking that water.
You okay, man?
I just choked on water.
Well, before we get started, I would like to ask you guys to please give me a like. It really helps my channel and it will push me to make more videos. So let's try to get this video to 100 likes.
What's going on, guys? Aaron here from Departures Capital, and we're here with Investing Hustler. You just had to finish off that protein shake real quick. And how's it going?
Just got back from the gym. I'm feeling
Nice.
pumped. Just kidding.
That's perfect.
No,
Perfect.
good, man. And we're here. We're going to talk about a non-marijuana related. Our
Nice.
channels are pretty much based on marijuana companies, and they get the biggest hits, the most amount of views. But we're trying to expand our horizons. So
Exactly. We're getting into, we're just trying to cover everything. Alrighty.
Let's go straight to the article. So today we're going to talk about the 3 top growth stocks.
All right, let's see it.
So the title is the 3 top growth stocks to buy in December. And of course, it's by Motley Fool. I have really grown to like the Motley Fool.
By Max with a double X.
But we're going to expose them a little bit right now before we get them. So the Motley Fool, this is their YouTube channel, right, guys? They have 40,000 subscribers. But look at those views. Actually, they do have some views here. But here, 3 days ago, 17 views. 1 day ago, 0 views. 1 day ago, 2 views. So I hope my channel doesn't die out like that one day. Like I would expect with 40K subscribers, I'll be getting minimum like 4K views per video. So 3 top growth stocks to buy in December. So sometimes it's easy to spot great growth stories. Apple, Amazon, and Netflix are prime examples. Other times, the best growth stock to buy aren't so obvious. That's been the case with boring old water heater manufacturers, AO Smith, which has delivered a 10-year return of 900.
Damn, that's good.
With dividends included, and that includes a 30% slide since the beginning of 2018.
Wow.
So those are nice gains. So no matter where you find great long-term businesses to own, holding even one epic growth stock can drive the gains of your entire portfolio. Knowing that, we asked 3 contributors at Motley Fool for their best ideas, and here's why they choose US Silica, ticker symbol SLCA, Shopify, ticker symbol SHOP, and Wynn Resorts. Actually, I want to take a look at Wynn Resorts because I know their share prices have been beat up in the past how long, and I've been tempted to buy into Wynn.
Yep.
Ever since the CEO had those allegations.
They might just be the next winner.
Wynn. Oh no, hold on. Let's look at the 1-year chart. As you can see, look at that. Wynn at
Wowzers.
a high point
50%.
$2, and they've went to a low of that would have been a great pickup point, $92, and even now they're still at 106. So they pretty much lost half of their price,
Dividend, no dividend.
So right now they're recommended. Let's just look at these first. A strong sell, even in the 1 minute. 1 minute it's a buy. And they do have a 2.81%
Not bad.
which isn't bad. A market cap of 11 billion and a PE ratio of 45. Kind of a high PE ratio. Aurora has a smaller PE ratio than that. But then again, Wynn Resorts has been around for a lot longer. They have 108 million outstanding shares. I mean, the company does seem to look a little overvalued when you look at its PE ratios. But
let's see the grander chart. Let's see the big charts here. See what's going on here.
So this is back in 08.
Wow.
Look at all time.
Oh wait, low of $20. Jeez.
So Wynn IPO'd at $12.80, and they seem to have very nice spikes and then back down. Spike down. Are they going to go for another spike? Who knows? But it actually does look like a nice stock to buy. On top of that, it does have a nice dividends at 2.81%.
I think just a little side note, with the markets in the shape they are, and we could fall a bit further, Wynn might drop a little further, but it does look to have some heavy support around the $90 to $100 range.
Yeah, that's tough because it could go back to these lows right here, $66.
Yeah, but I think it would take the market to really slide it a lot more, maybe. But I don't know. Have you been to a Wynn resort before?
No, but I heard it's amazing, and it's
Yeah, I've been to a bunch of different Wynn Resorts. They've got Wynn Resorts in Macau, over in China. They've got them all over the place, and they're pretty awesome.
And then we're looking at Shopify right now. Let's take a look
Yep.
at their 1-year chart. And they've been very volatile. This would be a nice swing trade company.
Definitely.
They're also recommended, a buy, sell, a strong sell. 1-minute chart, a sell, strong sell, strong sell. And do they have dividends? No dividends, no PE ratios,
No.
profit, market cap.
But I can see that one. I can see that one doing well because they're the future of like every entrepreneur's e-commerce. So an e-commerce is only going to grow.
But they do seem to be oversold right now because look at that. And look what happened last time they were oversold like that.
Yeah.
Had a nice little spike. So right now they are oversold. So we could see Shopify actually have a nice run. It might not be a big one, but it could be a nice little run.
A nice little swing trade, maybe up to like 160.
Yeah, and then SCLA, that's actually a company I don't have on my watch list, but I could definitely add them.
Silica is something that I don't know much about.
So this company has seemed to hit rock bottom.
Wow.
They're actually at the bottom of their 52-week low right now.
Oh my gosh, they're the 2011, 2012 lows.
Yeah, so this is probably the more riskier of the three, but it's actually it's near its bottom. So how much lower can it really go?
I like that chart though. I mean, it's just touching off those super time lows.
Straight up. And it does have a yield of 2.21% dividends, a market cap of 876 million. So it's the smallest market cap of all three companies, and a PE ratio of 9.9. That's actually a very good PE ratio.
Oh, that's great PE ratio. That's a value stock right there.
Yeah, so this actually looks like an amazing company right now. Okay, well, I guess we could go back to the article, but it is a high risk because it's like catching a falling knife because
exactly
has just been dropping. Let's see if it could go back to its IPO, which would be oh no, not even its IPO. Its lowest it's ever been was $9.10. So it's a possibility, but it does
could lose another 15%. But yeah, I mean the stock looks extremely
but at this point, if you buy this company, you're probably holding on to it for 10, 20 years because you're just collecting those dividends and then
hoping for growth,
hoping it recovers. So yeah, there you go. That's the three companies that they're talking about.
Will this bottleneck lead to a gusher of growth? So this is talking about US Silica. Oil and gas producers have taken advantage of a new technology and favorable economics to drill hundreds of sometimes thousands of wells in each major shale region, but there's a catch. They can't complete the wells and put them into production until more pipeline capacity is added to take the crude oil, natural gas, and NGLs away. Since a steady supply of frac sand isn't needed until wells are completed, and there were a record 8,545 drilled but uncompleted DUC wells in mid-October, that's a problem for US Silica. It's a big reason shares have lost 63% of their value since the beginning of 2018. While the anxieties of Wall Street are understandable, the business isn't struggling nearly as much as the stock price reflects. In the first 9 months of 2018, revenue grew 38% over the year-ago period. An asset impairment led to an 8% decline in operating income in the comparison period, although it grew 5% when that's excluded. A more legitimate concern would be rising interest expense, which grew 104% in the span and sapped net earnings. The acquisition of EP Minerals, an industrial ceramic business that will diversify revenue away from the oil and gas customers, explains that surge. It will need to begin delivering higher income to mitigate the effect of interest payments on the bottom line. All of that said, there's a lot for investors to look forward to. The number of DUCs should begin to trek lower in 2019 as multiple major pipeline projects come online, notably several in the Permian Basin. That should lead to higher sales volumes, while US Silica's last mile logistics business guaranteeing on-time deliveries to customers could also be a boom for business. Meanwhile, progress continues to be made integrating EP Minerals, which should lead to a further drop in operating expenses. The recently announced price increases of 2% to 9% for the industrial segment that go into effect on the first day of 2019 should also boost earnings. Given the growth prospects and a dirt cheap stock trading at 0.7 times sales and a PEG ratio of just 0.1, investors should strongly consider US Silica stock.
Wow. 0.1. That's cheap. That's a good. All right, well, I guess we can move on to the growth stock to buy now before it reports holiday sales.
Yes.
So this is Shopify. E-commerce sales grew 14.5% year over year in Q3 2018, according to the Bureau of Labor Statistics, BLS, and I suspect growth will be as strong in Q4 given holiday shopping trends, if not stronger. And if I'm right, then this is the great time to add Shopify to portfolios following a recent decline in its share price, which is true. But then again, what if we have a crash and you're stuck holding onto a company? But Shopify helps retailers manage traditional retail and e-commerce platforms seamlessly, providing them with a digital presence and tools that allow online payment, integrated inventory tracking, real-time analytics, and marketing solutions. The company's business is humming along nicely, with sales growing 58% year over year to 270 million last quarter. And importantly, the company's finally at a point where its scale is at starting to deliver bottom line profit. In Q3, the company's adjusted net income was 4.5 million. Based on its third quarter performance, the management thinks sales will be at 1.045 billion or better, and a non-GAAP operating income will eclipse 8 million for the full year. Shopify could top the forecast, though Adobe Analytics estimates in e-commerce sales grew 18.6% year over year between November 1st and December 6th. Shopify must have captured a lot of that growth, given CEO Lute tweets on December 1st. 10% of online sales on Black Friday went through Shopify stores. 5 years ago, below 1%.
That's awesome.
That's good. I'm surprised it didn't go up just because of that tweet.
Yeah, right.
Well, the BLS estimates that despite its growth, e-commerce still only represents less than 10% of all retail sales, since Shopify has ample opportunities to cross-sell solutions and grow merchandise volume on its platform. I think it's fast becoming a must-own growth stock. Shopify will never be confused with a value stock on traditional metrics, but it's trading about 8% below its summertime peak, and that makes me think buying it before it reports its post-holidays earning is smart. Holiday earnings are always expected to be good, and they did have a nice drop, and they do seem to be oversold, especially looking at these one-day charts. Let's just try to look at like 5-minute charts, see how that dropped. Yeah, so that was just a huge sell-off on that was just the other day. Wow. So literally I do expect Monday to just bounce back up, because it did have a gap right here, and usually it will make up for that gap. So even just for a day trade or a swing trade, it does look like but you never know, it could be a falling knife and it could continue to decline at this point.
Yeah,
but it does look very tempting. But no PE ratio, market cap 15 billion. But they are making, how much did they say, 300 million revenue? But yeah, we can move on to the next one.
All right, so bet on the high roller. Wynn Resorts, one of the fastest growing companies in the gaming industry is Wynn Resorts. Gaming industry, I guess I mean casinos, which recently expanded in Macau. Yes, I was just talking about that. I've actually been to their Wynn Resorts, both of their Wynn Resorts in Macau. Wynn Resorts, which recently expanded in Macau and has a new property near downtown Boston set to open in 2019. The company is one of only 6 concessionaires in the world's largest gaming market, Macau, and operates the most profitable property on the Las Vegas Strip, Wynn Las Vegas. And by the way, Macau is like a cash cow, because where it's located right beside some of the wealthiest metropolises in China, and everyone just goes there to spend money. So they just spend. Like there's a Rolex shop every 2 seconds. But anyways, consider that the opening of the Wynn Palace in Macau drove a 69% revenue increase over the past 3 years. Damn. And with 730 million of the company's 1.71 billion in revenue in the third quarter alone. So the Wynn Palace continues to be a big growth driver as it matures and takes market share in Macau. So the 2 big growth projects on the horizon for Wynn Resorts will keep revenue and EBITDA moving higher. The 2.6 billion Encore Boston Harbor is due to open mid-2019 and will be Wynn Resorts' first foray to the East Coast. Given the new market, it's difficult to determine what revenue and EBITDA will look like, but given competitors' performance, I don't think it's out of the question to expect at least $300 million in EBITDA annually. In Las Vegas, Wynn is expanding its convention facility to capitalize on a strong convention business on the north side of the Las Vegas Strip. It's positioned next to Las Vegas Sands convention space and adjacent to Las Vegas Convention Center. Is perfect for additional space that will cater to Wynn's typical high-end clients. This should help drive additional traffic to the casino and keep hotel rooms full during the week. Wynn's shares have struggled recently as Macau's gaming revenue has plateaued and the company itself has faced a full turnover in management, which we all know about that. Well, but long term, the company still has some of the best assets in the gaming industry and will only grow those assets over the next year, keeping the growth train going.
Another great article by Motley Fools.
Yes, sir.
And we could take a look at Wynn one last time.
Yep. I did not know that Macau was for 69%.
It's honestly, all these companies are very tempting. They're very tempting, especially seeing how much Wynn has declined in the past like few months, especially since those allegations with their CEO.
Yeah, seriously.
It was like a sex scandal or something.
Yeah.
So yeah, it's very tempting. Like, just how low can it go? It might have already hit its bottom right here. As you can see, they are oversold right here. So it might have hit the bottom and then they rebounded.
Yeah.
And they do look like they're currently uptrending. They're hitting higher lows every time.
Mm-hmm.
So it's very tempting. But once again, just because we talked about these companies does not mean you guys should invest into them. This is strictly for educational and entertainment purposes. Make sure you do your homework, do your due diligence. And if you guys enjoyed this video, don't forget to give us a thumbs up. And if you're not subscribed, don't forget to hit that notification bell and smash that subscribe button. And I hope you guys enjoyed this video. We'll see you guys next time. Bye-bye.